Before we dive in, please remember that this video is for educational purposes only and is not financial advice. I am not a financial advisor, and you should always consult with a qualified, licensed professional before making any major financial decisions, especially one as significant as buying a home. Two people, let's call them Alex and Ben, walk into the same bank on the same day. They both want to buy a $350,000 house. They have the same job, they make the same income, they have the exact same amount saved for a down payment. On paper, they are identical. But Alex walks out with a mortgage approval at a 4.5% interest rate. Ben walks out with an approval at 5.5%. That 1% difference sounds small, right? Almost insignificant. But over the life of a 30-year loan, that 1% will cost Ben over $75,000. $75,000. That's a brand new luxury car. It's a college fund for a child. It's a life-changing amount of money, vanished into thin air because of one tiny difference between him and Alex. A 40-point gap in their credit scores. That 3-digit number sitting on your credit report right now is the single most powerful and most expensive number you will ever own. It's more than just a score. It's a secret handshake with the financial world. It dictates whether you get the keys to your dream home or get the door slammed in your face. It determines whether you pay a fair price for your mortgage or a massive penalty, a risk tax, that bleeds you for tens or even hundreds of thousands of dollars over time. For too long, this number has felt like a mystery, controlled by shadowy bureaus and complex algorithms designed to be confusing. You check your score on some free app and it says 720. A week later, it's 705. Why? You paid all your bills on time. What happened? It's this feeling of powerlessness that costs Americans billions of dollars every single year. Well, that stops today. The entire purpose of this presentation is to pull back the curtain and expose the exact system lenders use to judge you based on your credit score. We are going to demystify this number and turn it from a source of anxiety into your most powerful tool in the home buying process. By the time you're done watching, you will understand the secret language your credit score speaks to banks. You will know precisely why your score is what it is, what specific levers you can pull to change it, and how to position yourself to look like the perfect low-risk applicant that lenders are desperate to give their best rates to. We're not talking about vague tips like pay your bills on time. We are diving deep into the machinery of the system. To do that, we first have to understand what a credit score actually is. At its core, a credit score is a risk assessment. It's a grade on your financial report card that tells a lender one simple thing. If we lend this person a huge amount of money, how likely are they to pay it back on time, every time? That's it. It's a prediction of your future behavior based on your past actions. Now, you might have seen different scores from different places. Credit Karma, your credit card statement, your bank app. It's confusing. But in the world of US mortgages, one name reigns supreme: FICO. Not VantageScore, which is what many free apps show you, but FICO. Lenders use specific and often older versions of the FICO scoring model to make their decisions. So, when we talk about your credit score for a home loan, we are talking about your FICO score. And that FICO score is not one single thing. It's a recipe made up of 5 key ingredients, each with a different weight. Understanding this recipe is the first, most critical step to taking control. The first and most important ingredient, making up a massive 35% of your score, is your payment history. This is the heavyweight champion. It is the foundation upon which your entire credit profile is built. It answers the most fundamental question: do you pay your debts as agreed? A single late payment, just one 30-day delinquency reported to the bureaus, can be catastrophic. It can drop an excellent score by 60 to 100 points overnight. Think of it like a trust exercise. Every on-time payment is a successful catch. Every late payment is dropping the person who trusted you. A mortgage lender is about to trust you with hundreds of thousands of dollars. If your report shows you couldn't be trusted to pay a $50 credit card bill on time last year, why would they believe you'll handle a $2,000 mortgage payment every month for 30 years? This is non-negotiable. Perfection here is the goal. One late payment can stay on your report for 7 years. It's a long, damaging shadow. The second biggest ingredient at 30% of your score is called amounts owed, but a better name for it is credit utilization. This is probably the most misunderstood part of the credit score, and it's where people make the most mistakes. This isn't about how much debt you have in total. You could have $100,000 in student loans and still have an 800 credit score. This is about how much of your revolving credit you are using. Revolving credit means credit cards and lines of credit. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on that card, your utilization is 50%. If you have a $1,000 balance, it's 10%. From a lender's perspective, a high utilization ratio is a massive red flag. It signals that you might be overextended, that you're relying on debt to live, and that you might be close to financial trouble. It screams risk. The lower your utilization, the better. The conventional wisdom says to keep it below 30%. The people with the highest scores, the 800+ club, keep it below 10%. This is also the fastest way to change your score. Paying down your credit card balances can boost your score significantly in as little as 30 days. The third ingredient, worth 15%, is the length of your credit history. This is all about seasoning. Lenders want to see a long, established track record of responsible behavior. This is why closing your oldest credit card, even if you don't use it, can be a terrible mistake. That card is the anchor of your credit age. When you close it, the average age of all your accounts drops, and your score often drops with it. A lender sees a 25-year-old with a 2-year credit history very differently than a 25-year-old who was made an authorized user on their parents' credit card at age 16 and now has a 9-year history. One looks like a rookie, the other looks like a seasoned pro. There's no quick fix for this one, it just takes time. But knowing this prevents you from making a critical error like closing old accounts right before you apply for a mortgage. Next up, accounting for 10% of your score, is new credit. This category looks at how recently and how often you've been applying for new credit. Every time you formally apply for a loan or a credit card, it results in a hard inquiry on your report. A single hard inquiry might only ding your score by a few points, but a flurry of them in a short period of time sends a very dangerous signal to a mortgage lender. Can look like desperation. It suggests you're short on cash and are trying to open up new lines of credit to stay afloat. This is why you should never, ever go out and finance a new car, new furniture, or open a new store credit card in the months leading up to your home loan application. It's one of the easiest ways to sabotage your own approval. You want to look financially stable and calm, not frantic and desperate for credit. Finally, the last 10% of your score comes from your credit mix. This is the least impactful, but it still matters. Lenders like to see that you can successfully manage different types of credit. A healthy mix might include revolving credit, like credit cards, and installment loans like a student loan or a car loan. It shows you're a versatile and responsible borrower. If all you've ever had is one student loan, or just one credit card, your score might be slightly lower than someone with a more diverse portfolio of accounts, even if everything else is equal. This doesn't mean you should go out and get a loan you don't need just to improve your mix. But it helps explain why your score might be stuck at a certain level. So there it is. 35% payment history, 30% amounts owed, 15% length of history, 10% new credit, and 10% credit mix. This is the FICO recipe. This is the blueprint lenders use to grade you. Your score is nothing more than the sum of your actions in these 5 categories. Now that you understand the blueprint, you understand where to focus your energy. You know that paying down a credit card is infinitely more impactful than worrying about your credit mix. You know that avoiding a single late payment is the most important financial promise you can keep. This knowledge is the first step. But it's only half the battle. Knowing the ingredients is one thing. Understanding how the chef, the mortgage lender, actually uses that recipe to decide your fate, and your interest rate, that's where the real money is saved. And that's exactly what we're breaking down next. So let's pull back the curtain. Imagine for a moment that you're not the one applying for the loan. Instead, you're the loan officer. You're sitting at a big mahogany desk, and on it lands a folder. Inside is someone's entire financial life. They're asking you personally to lend them $400,000. Not your money, of course, but the bank's money. Your job, your entire career depends on making good decisions. You have to decide if this person is a safe bet or a risky gamble. How do you do that? You can't just look them in the eye and trust your gut. You need data. You need a simple, standardized way to measure risk. And that, right there, is the entire purpose of a credit score. It's not a judgment of your character. It's not a measure of your worth as a person. It is a risk assessment score, plain and simple. It's the lender's crystal ball. It tells them, based on your past financial behavior, the statistical likelihood that you will pay back this massive loan on time, every single time for the next 30 years. Think of it like this. If you were to lend your brand new car to 2 different friends, which one would you choose? The friend who always returns things in perfect condition, with a full tank of gas? Or the friend who once forgot to tell you about that new dent in the bumper? Your credit score is your car lending reputation, but for money. And when hundreds of thousands of dollars are on the line, that reputation is everything. So, how do lenders actually read this score? They don't just see a number. They see tiers or categories of risk. And where you fall determines everything. Let's start at the top. The penthouse suite. This is the 800 to 850 range. Lenders call this exceptional. If your score is in this stratosphere, you are the VIP. You're not just applying for a loan. You're being courted. Lenders are literally competing for your business. They see you as a near zero risk. They know you pay your bills, you manage your debt flawlessly, and you have a long, pristine history of financial responsibility. For you, they roll out the red carpet. This means you get access to the absolute lowest interest rates advertised. As low as rates you see on billboards? They're talking to you. Your loan application will sail through underwriting with fewer questions and less paperwork. You are, in the eyes of the bank, the perfect borrower. Just below that, from about 740 to 799, is the very good tier. This is the A- student who is functionally identical to the A+ student. You are considered a very safe, very reliable bet. You might have slightly more debt or a shorter credit history than the 800 club, but you are still in the top echelon of borrowers. You will also get fantastic top-tier interest rates, maybe a tiny, almost unnoticeable fraction of a percent higher than the absolute best. For all practical purposes, if you're in this range, you are in an excellent position. You'll have your pick of lenders and loan products, and the process will be smooth. Now we get to the most common category for American homebuyers. The 670 to 739 range. This is the good credit tier. This is the workhorse category. You are considered an acceptable risk. You've proven you can handle credit responsibly. You likely have a solid mix of credit accounts and a history of on-time payments. You are the bread and butter of the mortgage industry. Lenders are happy to work with you. However, this is where the differences start to become real. The interest rate you're offered will be noticeably higher than what the 740+ crowd gets. It will still be a competitive rate, but it's the first step down the ladder. You might also face slightly stricter requirements for your debt-to-income ratio, or be asked for an extra document or two during underwriting. You're a good bet, but the lender is just a little more cautious. Dropping down again, we enter the 580 to 669 range. This is often called the fair credit tier, but in the mortgage world, it's the prove it to me zone. A lender looks at a score in this range and sees a story with some conflict. Maybe there were a few late payments a couple of years back. Maybe your credit cards are maxed out. Maybe you don't have a long credit history. Whatever the reason, your score signals a higher statistical risk of default. Now, can you get a mortgage with a score in the 600s? Absolutely. This is the sweet spot for government-backed loans like FHA loans, which are specifically designed for this type of borrower. But for a conventional loan, it gets tough. And the price you pay is steep. Your interest rate will be significantly higher. You'll also be required to pay for private mortgage insurance, or PMI, which can add hundreds of dollars to your monthly payment. Expect the lender to scrutinize every single line of your application. They'll want more documentation, more explanations, and more reassurance that you are not the risk your score suggests you are. Finally, we have the sub 580 range. This is poor credit. In the eyes of a conventional mortgage lender, this is the danger zone. Getting a standard mortgage from a major bank with a score below 580 is nearly impossible. It doesn't mean homeownership is off the table forever, but it means the main road is closed for construction. You'll have to take a detour, which usually involves working with specialized lenders who deal in high-risk loans, and the terms will be punitive. We're talking about sky-high interest rates and hefty fees. For most people in this range, the best path forward isn't to apply for a loan, but to hit pause and focus intensely on credit repair. Okay, so we've talked about these tiers: exceptional, good, fair. But what does this actually mean for your wallet? Let's stop talking in the abstract and use some cold, hard numbers. Let's imagine two people, Sarah and Mike. Both want to buy a house, and both are applying for the exact same $400,000, 30-year fixed-rate mortgage. They have the same income, the same down payment, everything is identical, except for their credit score. Sarah has a very good score of 760. Mike has a fair score of 650. The lender offers Sarah a great interest rate, let's say 6.5%. Her monthly principal and interest payment comes out to about $2,528. Now Mike, with his 650 score, the lender sees him as a bigger risk. They approve him, but his interest rate is 7.5%. That 1 percentage point might not sound like a huge deal, but let's do the math. Mike's monthly principal and interest payment is $2,796. That's a difference of $268 every single month. That's your car payment, your grocery bill, your utility bills. Every month for 30 years, Mike is paying $268 more than Sarah for the exact same house. Over the course of just 1 year, that's over $3,200 extra. Over 5 years, it's more than $16,000. But here's the number that should really stop you in your tracks. Over the full 30-year life of the loan, Mike will pay over $96,000 more in interest than Sarah will. Let me say that again. $96,000. All because of the difference between a 650 and a 760 credit score. That is the price of a brand new luxury SUV. It's a full college education for a child. It is a life-changing amount of money, determined by a 3-digit number before you even walk through the front door of your dream home. This is why your credit score isn't just a number. It's a direct reflection of your financial future. It dictates not just if you can buy a home, but the very quality of life you will have while living in that home. Now, it's also important to know that sophisticated lenders look beyond just the raw score. They look at the trend. A 680 score that was a 626 months ago is viewed much more favorably than a 680 score that was a 746 months ago. One is a story of recovery and responsibility, the other is a story of recent trouble. They also consider the type of loan. A VA loan for a veteran or an FHA loan for a first-time homebuyer will have more lenient credit requirements than a jumbo loan for $1 million mansion. So we've laid it all out. We've seen the tiers from the VIP room to the penalty box. We've done the math and seen how a few points can translate into $100,000 over time. The stakes are incredibly high. The natural question is, what now? What if you're looking at your own score and it's not in that 740-plus club? What if you're Mike, not Sarah? Is your fate sealed? Are you destined to pay tens of thousands of dollars more for your home? Absolutely not. Your credit score is not set in stone. It is a living, breathing number that you can influence, control, and improve. The power is in your hands. But to change it, you have to understand exactly what goes into it. What is the single biggest ingredient in that secret recipe? What's the one thing that, if you focus on it, will have the most dramatic impact on raising your score? That one factor accounts for a massive 35% of your entire score. And in the next part, we're going to put that one factor under the microscope and give you the exact actionable playbook to master it starting today. So let's put that 35% factor, your payment history, under the microscope. This isn't just one piece of the puzzle. It's the entire foundation. Think of it like this. If you're building your dream home, you wouldn't use cracked, crumbling concrete for the foundation, would you? Of course not. Because no matter how beautiful the house is on top, a weak foundation guarantees it will eventually collapse. Your payment history is that concrete foundation for your financial life. Lenders see it as the single most reliable predictor of your future behavior. It's their crystal ball. It answers the one question that matters more than any other. If we lend this person a huge sum of money, can we trust them to pay it back on time every time? A perfect payment history tells a story of reliability, discipline, and trustworthiness. A spotty one tells a story of risk. And when a mortgage lender sees risk, they do one of two things. They either deny your application outright, or they charge you a fortune and higher interest rates to compensate for that risk. We're talking tens, even hundreds of thousands of dollars over the life of a 30-year loan. All because of this one factor. But here's what most people get wrong. They think payment history is a simple yes or no. Did you pay on time? Yes. Good. Did you miss a payment? No. Bad. But the algorithm is so much more sophisticated than that. It doesn't just see black and white. It sees shades of gray. It analyzes 3 critical dimensions of your late payments: recency, frequency, and severity. First, recency. How recently did you miss a payment? A single 30-day late payment from 5 years ago is like a small scar. It's healed, it's part of your history, but it's not an open wound. A lender might not love it, but they can probably live with it. A 30-day late payment from last month? That's a blaring 5-alarm fire. It tells the lender that you are struggling right now. It doesn't matter if you had a perfect record for 10 years straight. That recent misstep screams instability, and it will tank your score. Second, frequency. How often are you late? Is this a pattern? One late payment in 7 years can often be explained away as a simple mistake. A vacation, a new bank account, a bill that got lost in the mail. But 2 late payments in a year? 3. Now you're not just making mistakes, you're establishing a pattern of behavior. The algorithm sees this and concludes you are a chronically risky borrower. It's the difference between tripping on the sidewalk once and being unable to walk in a straight line. And third, severity. This is the big one. How late was the payment? A payment that is 30 days late is bad. It'll drop your score, no question. But a payment that goes 60 days late is significantly worse. It's a bigger red flag, and it hits your score much harder. And a payment that hits 90 days late? That's a catastrophic event for your credit score. At 90 days, the damage is severe and long-lasting. And if it goes beyond that, to 120 or 150 days, and gets charged off by the original creditor and sold to a collection agency, that is the financial equivalent of a nuclear bomb. A charge-off or a collection account can stay on your report for 7 years, and can be an absolute deal-breaker for many mortgage lenders, no matter what the rest of your profile looks like. So, how do you build a bulletproof foundation? How do you master this 35% and make it work for you instead of against you? It comes down to a simple, actionable playbook. Step 1 is the audit. You can't fix what you don't know is broken. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. Go to the official government-mandated site, annualcreditreport.com. Get all 3. Do not skip this. Sit down with them and go through every single account line by line. Are there any late payments listed that you know you paid on time? Clerical errors happen more often than you think. Is there an account you don't even recognize? That could be a sign of identity theft. Is an old negative item still showing up after the 7-year reporting limit has passed? Dispute every single inaccuracy you find. A single incorrect late payment removal can sometimes boost your score by 30, 50, even 80 points. This is the single most powerful first step you can take. Step 2 is to automate your entire financial life. We live in an age of technology, use it. The number 1 reason people pay late isn't because they don't have the money. It's because they simply forget. Life gets busy. A bill gets buried under a stack of mail. An email reminder gets lost in your spam folder. The solution is to remove human error from the equation. Log into every single one of your credit card accounts, your car loan, your student loans right now. Set up autopay. And here's a pro tip. If you're worried about a large unexpected payment overdrawing your bank account, you don't have to set it to pay the full balance. Just set it to pay the minimum payment due. This simple action acts as a safety net. It guarantees you will never get a 30-day late mark on your credit report, ever again. You can, and should, always go in and pay the rest of the balance off manually before the due date to avoid interest, but that minimum payment safety net is non-negotiable. Step 3, for those who are still resistant to autopay, is the calendar method. Become a slave to your digital calendar. For every single bill you have, create 2 recurring events. The first alert should be set for 1 week before the due date. This is your heads-up reminder. The second alert should be set for 48 hours before the due date. This is your final warning, do it now reminder. It might seem like overkill, but when a single late payment can cost you thousands on a mortgage, overkill is exactly what you need. Step 4 is the secret weapon. The goodwill letter. Let's say you followed all the rules, but a few years ago you had one slip up. A single 30-day late payment on a credit card you've had for a decade, with an otherwise perfect history. This is where you can try a goodwill adjustment. You physically write a polite, professional letter to the creditor. In it, you acknowledge the mistake, you briefly and humbly explain the circumstances if there were any, and you highlight your long history of on-time payments since then. You then respectfully ask if they would consider making a goodwill gesture and removing the negative mark from your credit report. It is not guaranteed to work. They are under no legal obligation to do it, but you would be shocked at how often it does, especially if it was a one-time offense with a long-standing creditor. This single letter can erase years of damage from one mistake. Finally, a quick word on those catastrophic events, collections. If you have an account in collections, it's a gaping wound in your foundation. You must address it. When you contact the collection agency, your goal is to negotiate a pay-for-delete. This is an agreement where you pay the debt in exchange for them completely removing the collection account from your credit report, as if it never existed. Simply paying it off isn't enough. That just changes the status to paid collection, which still looks terrible to a mortgage lender. You need it gone. And you must, I repeat, must get this pay-for-delete agreement in writing before you send them a single penny. By auditing your reports, automating your payments, and strategically cleaning up any past mistakes, you are taking absolute control of the biggest factor in your credit score. You are building an unshakable foundation of trust that mortgage lenders can't ignore. You're telling them a story of absolute reliability. But here's the crucial twist. You can do all of this. You can have a perfect 100% on-time payment history for years, not a single late payment to your name. And yet, you could still be systematically destroying your credit score every single month without even realizing it. How? Because of the second biggest piece of the pie, a whopping 30% of your score that is all about how much you owe. And the way most people manage their credit card balances, even when they pay on time, is completely wrong. It's a silent score killer. In the next part, we're going to shatter the common myths about carrying a balance and show you the simple mathematical trick that can send your score soaring in as little as 30 days. Let's talk about one of the most persistent, most damaging myths in personal finance. It's a piece of advice that sounds so reasonable, so logical, that millions of people follow it, and it costs them dearly. The myth is this: you should carry a small balance on your credit cards from month to month. The idea is that by carrying a balance and paying a little bit of interest, you're showing the credit card companies and the credit bureaus that you're a profitable customer and a responsible borrower. It's a way of proving you can handle debt. This is, without a doubt, 100% false. It's a financial fairy tale. Let me be crystal clear. There is absolutely no FICO or VantageScore algorithm in existence that gives you bonus points for paying interest. Not one. Paying interest does not make your credit score go up. It's like believing you need to get a small cavity every year just to prove to your dentist that you're good at brushing your teeth. It makes no sense. The only thing carrying a balance does is make your credit card company richer. You are voluntarily giving them your hard-earned money for absolutely no benefit to your credit score. In fact, as we're about to see, it's actively harming your score. The truth is, the system is designed to reward something entirely different. It rewards your ability to manage debt, not your willingness to pay extra for it. And the single most powerful way to demonstrate this, the secret lever that can cause dramatic swings in your score in a matter of weeks, is a concept called the credit utilization ratio. This ratio is the second most important factor in your entire credit score, right after your payment history. It accounts for a massive 30% of your FICO score. And here's the beautiful thing. Unlike a late payment that can haunt you for 7 years, your credit utilization has no memory. You can fix it, and you can fix it fast. This is the mathematical trick I promised. So what is it? Your credit utilization is simply the amount of debt you're carrying on your revolving accounts, like credit cards, compared to the total credit limit you have on those accounts. Let's make it simple. Imagine you have just one credit card, and its limit is $10,000. If you have a balance of $3,000 on that card, your utilization is 30%. You're using $3,000 of your available $10,000. Now, you've probably heard the conventional wisdom. Keep your utilization below 30%. And that's not bad advice. It's a decent starting point. Lenders see anyone using more than 30% of their available credit as being a higher risk. It signals that you might be overextended, that you're relying on credit to live, and that you could be one emergency away from not being able to pay your bills. So, going from, say, 50% utilization down to 29% will definitely help your score. But the 30% rule is for amateurs. The people with elite, 800-plus credit scores, the ones who get the absolute best, rock-bottom interest rates on their mortgages, they play a different game entirely. They know the real magic happens when you get your utilization below 10%. And the ultimate cheat code? Getting it down to just 1%. The difference this makes is staggering. Let me tell you about a woman named Jessica. Jessica was the ideal loan candidate on paper. She had a 6-figure income, a stable job for over a decade, and she had never ever missed a payment on anything in her life. But her credit score was stuck at 680. She was frustrated. She was doing everything right, or so she thought. She applied for a mortgage pre-approval and got it, but the interest rate was a full point higher than what her friend with a 760 score had just gotten. On a $400,000 loan, that difference was going to cost her over $100,000 in extra interest over 30 years. It was devastating. So we took a look at her credit report. The problem was immediately obvious. Jessica, trying to be smart, used one primary rewards credit card for all of her monthly expenses: gas, groceries, bills, you name it. She wanted those airline miles. Her card had a $10,000 limit, and by the end of the month, she would often have charged $8,000 to it before paying it off in full on time every single month. Here is the secret that almost no one understands. Your credit card company typically reports your balance to the credit bureaus only once a month, and they don't report it on the day you pay your bill. They report the balance that's on your monthly statement on something called the statement closing date. So for Jessica, even though she was paying her $8,000 balance down to zero every month, on her statement closing date, the balance was $8,000. The credit bureau saw a report that said, Jessica is using $8,000 of her $10,000 limit. Her credit utilization ratio wasn't zero. It was 80%. In the cold, calculating eyes of the FICO algorithm, she looked like she was on the brink of financial collapse. Her high income didn't matter. Her perfect payment history didn't matter as much as it should have. That single sky-high utilization number was an anchor, dragging her entire score down. This is the trap millions of responsible people fall into. They pay their bill in full but at the wrong time. So here is the simple mathematical trick that can send your score soaring. It's not about spending less. It's about timing your payment. Find out your statement closing date for each of your credit cards. You can find it on your monthly statement or by calling the number on the back of your card. Then, set a reminder on your phone for 3 to 5 days before that date. On that day, log in and pay your balance down to almost zero. Leave a tiny amount, maybe $10 or $20 on the card. Let's go back to Jessica. We had her do this one thing. Instead of waiting for her bill, she logged into her account 3 days before her statement was due to close. She saw her $8,000 balance and she paid $7,990 of it right then and there. A few days later, her statement came out. The balance reported to the credit bureaus was now just $10. Her utilization on that card plummeted from a disastrous 80% to a pristine 0.1%. The next month, when her credit score updated, it jumped from 680 to 755. 75 points. In less than 30 days. She hadn't changed her spending. She hadn't gotten a new job or paid off a loan. She just changed the date she made her payment. She went back to that same mortgage lender, and her new interest rate saved her $98,000 over the life of the loan. $98,000 for 5 minutes of work. This is the power you have. For those of you with multiple cards, you can take this to the next level with a strategy the pros call AZEO, which stands for all zero except one. The strategy is simple. Pay every single one of your credit card balances down to zero before the statement closing date, except for one. On that one card, you let a very small balance report, again $10 or $20 is perfect. This shows the scoring models that you are actively using your credit, but your overall utilization is so low it's practically zero. This is the single fastest way to legally and ethically maximize the amounts owed portion of your credit score. Think about the implications for your home loan. A lender might have credit score tiers. Maybe 680 to 719 is one tier, but 720 and above is the top tier where the best rates are. That single jump, like the one Jessica made, can be the difference between a good loan and a great loan. It can be the difference between paying an extra $50,000 for your home or keeping that money in your pocket, for your family, for your future. This isn't a loophole. This is simply understanding the rules of the game and playing it better than anyone else. You're not hiding debt. You're just strategically showing the credit bureaus a snapshot of your finances at the most opportune moment. You are taking control of the data that defines you. But what if your problem isn't just utilization? What if your credit report is being held hostage by mistakes from the past? A late payment from 3 years ago that still stings every time you see it. A collection account you thought was long forgotten, but is still lurking in the shadows, suppressing your score. Most people think you just have to surrender, to wait 7 long agonizing years for these negative marks to finally disappear. They believe there's nothing they can do. They're wrong. In the next part, we'll reveal the powerful, yet little-known strategies for dealing with these negative marks, and how you might be able to get them removed from your report legally and ethically, years ahead of schedule. The first and most powerful tool in your arsenal is a federal law called the Fair Credit Reporting Act, or the FCRA. Now that sounds boring and official, but I want you to think of it as your secret weapon. This law dictates the rules of the game for the credit bureaus, Equifax, Experian, and TransUnion, and for the creditors who report to them. And here's the most important rule, the one that changes everything. Every single item on your credit report must be 100% accurate and 100% verifiable. Not 99%. 100. If a negative item on your report fails either of those two tests, accuracy or verifiability, it must be removed. Period. This is where the game shifts in your favor. Most people think a negative item is like a permanent stain, a brand on your record for 7 long years. But the reality is the system is a chaotic, automated mess. Information is passed between thousands of companies, from original lenders to third-party debt collectors, and then to the 3 giant credit bureaus. Mistakes aren't just possible. They are incredibly common. Names get misspelled, dates get mixed up, balances are reported incorrectly, accounts get duplicated. Sometimes, an account that isn't even yours ends up on your report. Each one of these errors is a golden ticket, an opportunity to legally demand the removal of that negative mark. So, how do you do it? It starts with a process called a dispute. You are not asking for a favor. You are exercising your legal right. The first step is to pull your full, detailed credit reports from all 3 bureaus. I'm not talking about the summary you see on a free credit app. I mean the official line-by-line reports. You can get these for free once a year from the official government-mandated site, annualcreditreport.com. Once you have these reports, you become a detective. You're going to comb through every single negative account with a fine-tooth comb. You're looking for any discrepancy, no matter how small. Is the date of first delinquency exactly right? Is the account number perfect? Is the balance listed the same across all 3 bureaus? Is the original creditor's name spelled correctly? Any inconsistency is grounds for a dispute. You see, the secret isn't necessarily proving the debt isn't yours. The secret is that the burden of proof is not on you. It's on them. When you file a dispute, you are officially challenging the credit bureau to prove that the information is 100% accurate and verifiable. You draft a formal letter, and I highly recommend sending a physical letter via certified mail with a return receipt, not just clicking a button online. An online dispute often forces you to agree to terms that limit your rights. A physical letter is a serious, documented legal challenge. In this letter, you clearly identify the account in question, state that you are disputing its accuracy, and explain what you believe is wrong. You don't need to write a novel. Be clear, professional, and to the point. Once the credit bureau receives your letter, a timer starts. By law, they have a limited amount of time, typically 30 days, to investigate your claim. This means they have to contact the original creditor or the collection agency that reported the information and ask them to provide proof that the item is accurate. And here's where the magic happens. These companies are giant, often disorganized bureaucracies. They are dealing with millions of accounts. The chances that they can find the original signed paperwork from 5 years ago and provide it to the credit bureau within that 30-day window are surprisingly low. They might have lost the records. The debt might have been sold and the new owner doesn't have the original documentation. Or they might simply decide it's not worth their time and effort to respond. If they cannot provide the required proof within the legal time limit, or if they simply don't respond at all, the credit bureau is legally obligated to delete the negative item from your report. It's gone. Not because you proved it was wrong, but because they failed to prove it was right. Just like that, a collection, a charge-off, a late payment that was dragging your score down by 50, 70, or even 100 points can vanish forever. But what if the negative mark is actually accurate? What if you know you were 30 days late on that car payment 3 years ago? It's a legitimate mark. Are you just stuck? Not necessarily. This is where we move from legal rights to strategic negotiation. The second strategy is called a goodwill letter. This is exactly what it sounds like. You are writing to the original creditor and asking for a gesture of goodwill. You're asking them to remove the accurate late payment from your report out of kindness. Now you might be thinking, why on earth would they do that? Because you're going to make a compelling case. A goodwill letter is not about making excuses. It's about taking responsibility while providing context. You send this letter directly to the creditor, not the credit bureau. And you don't send it to a generic P.O. box. You do some research to find the mailing address for a specific department, like the office of the CEO or the customer relations executive. A letter addressed to a specific person is far more likely to be read by a human being with the power to make a decision. In the letter, you start by being polite and professional. You state your account number and explain that you've been a loyal customer. Then you own the mistake. You say something like, I am writing regarding a 30-day late payment reported on my account in May of 2021. I take full responsibility for this oversight. Then you provide a brief, honest, and compelling reason for the lapse. Maybe it was a medical emergency, a job loss, a family crisis, or even a simple mistake like a missed autopay setup during a bank change. The key is to be human and relatable. After explaining the situation, you pivot to demonstrating your good behavior since that one mistake. You say, "Since that single incident, I have maintained a perfect payment history for the past 36 consecutive months, and I truly value my relationship with your company." You are showing them that the late payment was an anomaly, not a pattern. Finally, you make the ask. "Because of my strong payment history and the extenuating circumstances at the time, I am respectfully requesting a goodwill adjustment to have this one-time late payment removed from my credit report." Will this work every time? Absolutely not. Many companies have a strict policy against it, but it costs you nothing more than the price of a stamp and 30 minutes of your time. And if it works, the impact can be enormous. That one late payment, especially if it's more recent, can be a major anchor on your score. Getting it removed can provide an instant, significant boost, potentially moving you into a higher credit tier and saving you tens of thousands of dollars on your mortgage. It's a low-risk, high-reward strategy that far too few people ever even try. Between formal disputes for inaccurate information and goodwill letters for legitimate one-time mistakes, you now have two powerful ways to clean up your credit history. These aren't loopholes, they are established methods for ensuring your report is fair and accurate, and for seeking a second chance when you've earned it. But this brings us to the really tough stuff. What about the accounts that aren't just a simple mistake or a single late payment? I'm talking about the lingering medical collections, the old credit card that was charged off, the debt that you know is yours but you haven't been able to resolve. These are the items that can feel like a life sentence. Goodwill letters won't work, and if the data is accurate, a dispute will just come back verified. Seems like a dead end, but it's not. There is a third, more advanced negotiation tactic. It's a strategy that collection agencies absolutely hate, but one they will often agree to if you know exactly how to approach them. It's a way to potentially settle the debt for less than you owe, and get the entire negative account deleted from your credit report, as if it never existed. It's called a pay for delete, and understanding how to execute it is one of the single most valuable skills you can learn on your journey to homeownership. So let's break down exactly what it is, how it works, and how you can use it to completely erase a negative mark that's holding you back. A pay for delete is a negotiation. It's an agreement you make with the collection agency where you offer to pay a debt, often a settled amount that's less than the original balance, in exchange for their promise to completely remove the entire collection account from your credit reports with Equifax, Experian, and TransUnion. This is fundamentally different from just paying a collection. If you just call up a collector and pay an old bill, the account status on your credit report will be updated to paid collection. And while that's slightly better than unpaid collection, it's still a major negative item. It's a big ugly scar on your report that tells lenders, this person once failed to pay a bill on time. A paid collection can still suppress your credit score for up to 7 years from the original date of delinquency. A pay for delete, on the other hand, is like cosmetic surgery for your credit report. The scar is gone. The entire account vanishes. Poof, as if it never happened. For a mortgage lender, there's a world of difference between a clean report and one with a paid collection on it. So, how do you actually do it? Let's walk through a real-world scenario. Meet Jessica. Jessica and her husband found their dream home. They'd been saving for years, had a solid down payment, and stable jobs. They submitted their mortgage pre-approval application, confident they'd sail through. A day later, they got a call from the loan officer. The news was bad. Jessica's application was flagged because of a 620 credit score. The lender needed a 640 minimum. She was crushed. She checked her credit report and found the culprit, a 3-year-old medical collection for $400. She vaguely remembered a dispute with an insurance company over a lab test, but she thought it was resolved. It wasn't. It had been sold to a third-party debt collector and was now torpedoing her homeownership dreams. Jessica's first instinct was to panic and just call the number on the credit report to pay it immediately. This is mistake number 1, and it is a critical one. Never, ever call a collection agency without a plan. The moment you get on the phone, you are in their world, playing by their rules. They are masters of high-pressure tactics. They record every call. If you say something like, "I'm calling to pay the $400 debt I owe for that old medical bill," you have just legally acknowledged the debt is yours. In many states, this can restart the clock on the statute of limitations, giving them more time to legally pursue you for it. You've also shown your hand. You've shown you're desperate, and you've lost almost all of your negotiating leverage. So what should Jessica have done? The exact opposite. The entire pay-for-delete process must be handled in writing. You want a paper trail. You want proof. This isn't a casual conversation. It's a business transaction. Here is the 4-step process. Step 1 is to draft the letter. You are not going to use some generic template you find online. You are going to write a specific, powerful letter that accomplishes 3 things. First, it never ever admits the debt is yours. You use careful language like regarding account number XYZ that is appearing on my credit report. You are not saying my debt. You are referring to an account. Second, it makes a clear business proposition. It states that you are willing to offer a payment, say 50% of the original amount, in full settlement of the account. Third, and this is the most important part, it makes the payment conditional. The letter must state explicitly that this offer is contingent upon the collection agency's written agreement to perform a full deletion of the account from all 3 major credit bureaus within, say, 30 days of receiving the payment. Jessica, after doing her research, drafts this letter. She offers to pay $200 to settle the $400 account, but only if they agree in writing to delete the trade line. She sends this letter via certified mail with the return receipt requested. Why certified mail? Because it's proof. It proves they received your offer on a specific date. A collection agency can't later claim, "Oh, we never got that letter." Yes, you did, and here's the signature to prove it. Step 2 is the waiting game. The collection agency will respond in one of 3 ways. They might ignore you. They might send back a letter rejecting your offer and demanding the full amount. Or they might agree to your terms. Most often, they'll come back with a counteroffer. Maybe they reject the $200 but say they'll accept $300. This is where the negotiation begins. Remember your leverage. This is likely old debt that they purchased for pennies on the dollar. For a $400 debt, they might have paid the original creditor as little as $10 or $20. For them, getting $300 is a massive profit. They would much rather get a guaranteed $300 today than spend months and resources chasing a $400 debt they might never collect. They are running a business, and a pay-for-delete is often just good business for them. Let's say they agreed to Jessica's offer of $200. Now we move to the most crucial step of all. Step 3. Get the agreement in writing. They might call you and say, "Okay, we agree to your terms. Just give us your debit card number over the phone, and we'll take care of it." Do not do this. Under any circumstances, a verbal promise from a debt collector is worth absolutely nothing. You must insist they send you a formal, written agreement on their company letterhead that explicitly states they will delete the account from Equifax, Experian, and TransUnion in exchange for your payment of $200. If they refuse to put it in writing, it's a giant red flag. It means they have no intention of honoring the deal. You walk away. No written agreement, no payment. Period. Once Jessica receives that signed agreement in the mail, she moves to step 4, making the payment. And how you pay is just as important. Never give a collection agency your personal checking account information or your debit card number. That gives them direct access to your bank account, and shady collectors have been known to accidentally withdraw more than the agreed upon amount. Never send a personal check, because it has your account and routing numbers right on it. The safest way to pay is with a cashier's check from your bank or a money order. It's untraceable to your personal accounts and serves as concrete proof of payment. Send this payment again via certified mail. You want a full paper trail from start to finish. 30 to 45 days after they receive the payment, Jessica pulls her credit reports from all 3 bureaus. And there it is. Or rather, there it isn't. The collection account is gone. Vanished. Wiped clean. A week later, her loan officer runs her credit again. Her score has jumped from 620 to 685. A 65-point increase from deleting one single account. She is now well above the lender's minimum requirement. She not only gets approved for the loan, but that 65-point jump qualifies her for a significantly better interest rate, saving her over $30,000 over the life of her 30-year mortgage. That is the power of a pay-for-delete. It's not a magic trick. It's a simple, methodical business negotiation that you have the power to execute. It takes a little bit of patience and a few dollars for certified mail, but the return on investment can be life-changing. It can be the single action that takes you from denied to approved, from a high-interest loan to a great one. Now, removing negative items like collections is a massive step. But what if your report is already clean? What if you have no collections, no late payments, but your score is still stuck in the mid-600s, not quite high enough to get the best rates? You might be making one of the most common credit mistakes of all. Something that millions of responsible people do every single month without realizing it's costing them 50 points or more on their score. And it all has to do with a single number that most people completely misunderstand. Fixing it costs nothing, and it can boost your score in less than 30 days. But you have to understand how the banks see it first. Because the score you see on an app isn't the score your lender sees. And the rules they use to calculate it are completely different. Think of the credit score you see on your phone as the sticker price of a car. It's a number, it looks official, but it's not the price you actually pay. The score your mortgage lender uses is the out-the-door price, the one that actually matters, the one that determines your entire financial future. And the difference between the two can be staggering. Here's the secret the banks don't advertise. Most of the free apps you use, Credit Karma, Credit Sesame, even the one from your own bank, are showing you something called a Vantage Score. It's a perfectly legitimate credit scoring model, but it's not the one used for 90% of mortgage decisions in the United States. For that, lenders turn to the original recipe, the industry titan FICO. But it gets even more complicated. It's not just one FICO score. There are dozens of them. FICO scores for auto loans, FICO scores for credit cards, and the ones that matter to us, FICO scores for mortgages. And here's the kicker. The mortgage industry doesn't even use the newest, most forgiving FICO models. They use old-school, battle-tested, unforgiving versions. Specifically, they use FICO Score 2 from Equifax, FICO Score 5 from Experian, and FICO Score 4 from TransUnion. These models are practically antiques in the digital age. They were built on data from the 1990s and early 2000s. They think differently, they weigh things differently, and they are far, far more sensitive than the friendly score you see on your app. Why would they use such old models? 2 words: stability and predictability. These models have decades of data showing how people with certain scores behave over time. For the institutions like Fannie Mae and Freddie Mac, who buy up most of the mortgages in the country, that predictability is worth more than gold. They want to know with near certainty that you're not going to default. So they stick with the system they know, a system that hasn't changed in over 20 years. So when you apply for a home loan, your lender does something called a tri-merge credit pull. They pull all 3 of those old-school FICO scores at once. They get your FICO 2, your FICO 4, and your FICO 5. Now you'd think they'd just average them, right? Wrong. That would be too simple. Instead, they look at the 3 numbers and they throw out the highest one. They throw out the lowest one. And they use your middle score. That single number is your qualifying credit score. Now, if you're applying with a partner, a spouse, a co-borrower, it gets even more brutal. They pull the tri-merge report for both of you. They find your middle score, and they find your partner's middle score. Then they take the lower of those 2 middle scores. That's it. That one number dictates everything. It doesn't matter if you have an 820 score. If your partner's middle score is a 679, you are a 679 applicant. Period. Let me paint you a picture. Meet Alex and Jamie. For a year, they've been preparing to buy their first home. Alex is obsessed with their credit. Every morning, he checks their scores on his favorite app. He sees his score is a solid 760. Jamie's is a 735. They're ecstatic. They've read online that anything over 720 is great. They feel unstoppable. They find their dream house, put in an offer, and it gets accepted. They march into the lender's office, beaming with confidence, ready to get the best interest rate possible. The loan officer pulls their credit. The air in the room changes. The loan officer clears his throat and slides a piece of paper across the desk. Alex looks down. His FICO scores are 732, 728, and 725. His middle score is 728. Not the 760 he saw on his app, but still pretty good. Then he looks at Jamie's scores. They are 705, 698, and 695. Her middle score is 698. The lender looks at them and says, "Okay, so your qualifying score for this loan is 698. Alex's heart sinks. All that work, all that obsessive checking, and they're a sub-700 applicant. The interest rate they're offered is 0.5% higher than they expected. It doesn't sound like much, but over 30 years on a $400,000 loan, that 0.5% difference will cost them over $53,000. $53,000 gone, because the score on their app wasn't the score that mattered. So why the huge difference? Why was Alex's score 32 points lower and Jamie's 37 points lower? It's because these old FICO models are picky. They have different priorities. First, they are obsessed with the age of your credit history. The Vantage score you see on your app might be forgiving if you opened a new store credit card to get a 10% discount. But the old FICO models see that new account and panic. It shortens your average age of accounts, a key metric for them, and your score takes a nosedive. Second, they are extremely sensitive to collection accounts. Newer scoring models might ignore medical collections under a certain amount, or they might ignore collection accounts entirely once you've paid them off. The old mortgage FICO scores do not. They don't care if it was a $10 library fine or a $10,000 charge-off. A collection is a collection, and a paid collection is still a collection that happened. It's a black mark that haunts you for 7 long years, and those old models stare right at it. Third, they have a different view of what's called credit piggybacking. This is when you become an authorized user on someone else's credit card, usually a parent, to inherit their long, perfect payment history. Newer Vantage score models love this. You can get a 50 or 60-point boost almost overnight. The old FICO models are much more skeptical. They have algorithms designed to sniff out if you're just piggybacking to inflate your score. And if they suspect you are, they might give that account very little weight or even ignore it completely. That 760 Alex saw on his app was likely propped up by his dad's 25-year-old credit card. The mortgage FICO score saw right through it. And finally, there's the way they treat inquiries. When you apply for credit, it creates a hard inquiry on your report. The newer scores are smart enough to know that if you're shopping for a car loan, you might have 5 inquiries in a week, and they'll bundle them together and treat it as a single shopping event. The old FICO models are less sophisticated. They can be much more punitive, and seeing multiple inquiries, even for the same purpose, can make you look desperate for credit and knock your score down. So you're playing a game where the rulebook you've been given is for a completely different sport. You think you're playing basketball, but the bank is refereeing a hockey game. You're being judged by a secret, stricter standard. But here's the good news. Now you know. Knowledge of the game is the first step to winning it. You don't have to fly blind anymore. You can actually see these scores. There are services online like myfico.com, where you can pay a fee and see the exact same FICO 2, 4, and 5 scores that your lender will see. It's the single most important investment you can make before you even think about talking to a lender. Because fixing a 760 Vantage score is completely different from fixing a 728 FICO 2 score. You need to know which problems the real score is seeing. Once you know your true 3-digit identity in the eyes of the bank, you can start making surgical changes. You can stop wasting time on things that only boost your vanity score and focus on the levers that move the numbers that actually matter. And some of these levers are incredibly powerful. Remember that credit utilization trick I mentioned? The one that costs $0? It's 10 times more powerful when you know how these old FICO models think. What if I told you that by simply understanding the statement date on one credit card, you could make a payment 3 days earlier than you normally would, and have it rocket your FICO mortgage score up 30 points in less than a month? In the next part, we're going to break down that exact strategy, and 3 others just like it, the hidden playbook for rapidly boosting the only score that can get you the keys to your dream home. Alright, let's pull back the curtain. The first strategy is the single most powerful, fastest acting technique to manipulate your FICO mortgage score, and it's called the AZEO method. That stands for all 0 except 1. Sounds simple, and it is, but its impact is profound. Here's how it works. You take every single one of your revolving credit accounts, your Visas, your MasterCards, your store cards, and you pay the balance down to 0. All of them, except for 1. On that one single card, you leave a tiny balance, ideally between 1 and 5% of the credit limit. So if you have a card with a $10,000 limit, you leave a balance of $100. Now, why on earth would you do this? Seems counterintuitive. Wouldn't a 0 balance on everything be better? The answer is no, and this is where we get inside the mind of the FICO algorithm. The algorithm wants to see that you are an active and responsible user of credit, not that you've just hidden all your cards in a drawer. When all your cards report a 0 balance, the algorithm can sometimes interpret this as inactivity. But when it sees almost all of your available credit is free, and you're actively using a tiny fraction of it on one card, it reads this as the absolute pinnacle of responsible credit management. You are demonstrating maximum control. You have access to tens of thousands of dollars in credit, but you're choosing to use only 100. It's the ultimate power move. The key to making this work is timing. You can't just pay the cards down a week before you apply for the loan. You have to pay them down before the credit card company's statement closing date. That's the date they take a snapshot of your account and report it to the credit bureaus. This date is printed on your monthly statement. Pay the balances down to zero or that one tiny balance about 5 days before that closing date. Do this for all your cards. Within 30 to 45 days, as all the bureaus receive this new pristine data, your FICO mortgage score can rocket upwards. We're talking 20, 30, even 50 points for some people depending on where they started. This one move alone can take you from a denial to an approval, or from a high interest rate to a great one. The second strategy is what's known in the industry as piggybacking, and it involves becoming an authorized user on someone else's credit card. But not just anyone. This needs to be someone you trust implicitly, like a parent or a spouse, who has a long-established credit card with a perfect payment history and a very high credit limit. When they add you as an authorized user, you don't even need to get a physical card. What happens is the entire history of that account gets grafted onto your credit file. Imagine your parents opened a credit card the year you were born. They've never missed a payment in over 30 years, they have a $20,000 limit, and they keep the balance at or near zero. When you become an authorized user, that 30-year-old, perfectly managed account suddenly appears on your report. This does two incredible things instantly. First, it dramatically increases the average age of your credit accounts, a key factor in your score. If you only have a few young accounts, adding a 30-year-old one is like injecting decades of good history directly into your file. Second, it drastically lowers your overall credit utilization. Your total available credit just jumped by $20,000, while your total debt remained the same. This is like a shot of adrenaline for your score. Now, there is a huge warning label here. This only works if the primary account holder is flawless. If they ever miss a payment or run up a huge balance after you're added, their bad behavior will now stain your credit report. You are linking your financial fate to theirs. That's why this is a strategy reserved for people with deep, established trust. But when done correctly, the results can be almost instantaneous. The new account typically appears on your report within 1 to 2 billing cycles, and the score boost can be massive, especially for someone with a thin or young credit file. Okay, let's move to the third strategy, which is perfect for people who don't have a lot of credit history or need to improve their credit mix. The old FICO mortgage scores love to see that you can handle different types of debt, not just credit cards. They want to see an installment loan like a car loan or a personal loan, where you make fixed payments over time. But who wants to take on new debt right before buying a house? Nobody. So you use a hack, a credit builder loan. Here's the genius of it. A credit builder loan isn't a loan in the traditional sense. You don't get a lump sum of cash. Instead, the lender puts the loan amount, say $1,000, into a locked savings account for you. You then make small monthly payments, maybe $50 a month for 20 months, to the lender. Each and every one of those on-time payments is reported to all 3 credit bureaus as a positive payment on an installment loan. You are building a perfect payment history from scratch. Once you've paid the loan off, the bank unlocks the savings account and gives you your $1,000 back, plus any interest it earned. You've essentially forced yourself to save money while simultaneously adding a powerful, positive trade line to your credit report. For a mortgage underwriter looking at your file, this is a huge green flag. It shows you're proactive, responsible, and can handle the kind of fixed payments that a mortgage requires. While the AZEO method fixes your utilization and piggybacking fixes your credit age, the credit builder loan fixes your credit mix. It diversifies your profile, improves your reliability, often adding 10 to 20 crucial points to your score over a few months. Finally, the fourth strategy. This one is for anyone who has a past mistake holding them down. A single late payment from a year ago that's acting like a 100-pound anchor on their score. This is the Goodwill letter gambit. A single 30-day late payment can crush an otherwise perfect score. The problem is, it was a legitimate late payment, so you can't dispute it as an error. So what do? You ask for forgiveness. You write a polite, professional, and humble letter to the original creditor. You explain that you've been a loyal customer, you detail your otherwise excellent payment history, and you take responsibility for the one-time slip-up. It's critical to have a good reason: a medical emergency, a job loss, a bank error you didn't catch in time. You're not making excuses, you're providing context. You then politely request that, as a gesture of goodwill, they consider removing the negative mark from your credit report. You emphasize that you're in the process of applying for a mortgage, and this single blemish is having a devastating impact on the interest rate you can qualify for. Will this always work? No. Many large banks have automated systems and strict policies, but you would be shocked at how often it does work, especially with smaller banks or credit unions, A human being reads your letter, looks at your account, sees you've been a great customer aside from that one issue, and makes an executive decision to help you out. They instruct their team to submit a correction to the credit bureaus. If they do, that anchor is gone and your score doesn't just rise, it launches. The removal of a single late payment can easily boost a FICO score by 60, 80, even over 100 points. It is the ultimate Hail Mary, and it costs you nothing but a stamp and a little bit of your time. These 4 strategies, AZEO, piggybacking, credit builder loans, and goodwill letters, form the core of the RapidRescore playbook. They are surgical strikes designed to influence the specific factors that FICO mortgage scores care about most. But now that you have the tools to build your score, what exact number are you even aiming for? What is the magic number that unlocks the best interest rates? 720? 760? 800? And does that number change if you're getting a conventional loan versus an FHA or a VA loan? In the next part, we're breaking down the specific credit score tiers that lenders use, and we'll reveal the precise score that separates the good from the great, the number that will save you tens of thousands of dollars over the life of your loan. So let's pull back the curtain. Lenders don't just see a single number. They see a landscape divided into tiers, and where you fall on that map determines everything. Think of it like airline seating. Everyone gets to the same destination, but the cost and the comfort of the journey are worlds apart. First, you have the stratosphere, the financial first class. This is the exceptional tier, typically a FICO score of 800 to 850. If you're in this club, congratulations. You are a lender's dream. You've demonstrated a long, impeccable history of managing debt. To them, you are practically zero risk. You'll be offered the absolute lowest interest rates on the market, period. Lenders will roll out the red carpet, often reducing or waiving fees just to get your business. The application process for you will likely be smoother, faster, and require less scrutiny. You're not just applying for a loan, you're being courted. Now let's come down just a little bit into what many consider the true sweet spot. This is the very good tier, from 740 to 799. And right here inside this range is the magic number we've been talking about. While 800 is incredible, the number that truly separates the good from the great in the eyes of most mortgage lending systems is 740. Why 740? Because of something called risk-based pricing adjustments. Lenders bundle borrowers into risk categories. Once you cross the 740 threshold, you generally qualify for the best pricing tiers. The difference in the interest rate offered to someone with a 739 versus a 740 can be surprisingly significant. A single point can push you into a new bracket, unlocking the best rates available and saving you a fortune. This 740 and up range is the primary goal for any serious homebuyer. You're seen as highly reliable, and you'll have access to the most competitive loan products and interest rates, right alongside the 800-plus crowd. Next, we have the good tier, which typically runs from 670 to 739. This is where a huge number of Americans land. If your score is here, the odds of getting approved for a conventional mortgage are very high. You are considered a solid, creditworthy borrower. But, and this is a massive but, you will not get the best terms. You'll be approved, but you'll pay a premium for it. Your interest rate will be noticeably higher than someone in the 740-plus club. Lenders see a bit more risk, and they price that risk directly into your loan. You're on the plane, but you're an economy, and you paid a little extra for your ticket. Dropping down again, we enter the fair credit tier, from 580 to 669. This is the borderline. This is where the path gets rocky. Getting a conventional loan in this range is tough. It's not impossible, but you'll face much higher interest rates, and underwriters will put your application under a microscope. This is the territory where government-backed loans, like an FHA loan, become a critical lifeline. They are specifically designed to help borrowers in this credit range. However, that help comes at a cost, usually in the form of expensive mortgage insurance that you'll pay for years, sometimes for the entire life of the loan. Finally, we have the poor credit tier, which is anything below 580. In this range, securing a conventional mortgage is nearly impossible. Your options become extremely limited. Even with an FHA loan, which can technically go down to a 500 credit score, you'd be required to bring a much larger down payment, at least 10%, and face the highest possible rates and insurance premiums. A score this low signals a history of significant financial distress to lenders, making them extremely hesitant to extend hundreds of thousands of dollars in credit. So you see the tiers. But what does this actually look like in your bank account? Let's make this real. Meet two brothers, let's call them Mark and David. They're twins. They have the same job at the same company, earning the exact same salary. They've both saved up the same 20% down payment for their first home. They're even applying to buy identical houses in the same neighborhood for $400,000. Their financial lives are a mirror image of each other in every single way, except for one small detail. Mark, after a few late payments years ago, has a FICO score of 735. He's in that good tier. David, who has been a little more diligent, has a score of 745. He's just 10 points higher, but he's crossed the threshold into the very good tier. They both apply for a $320,000 mortgage. Mark, with his 735 score, gets offered a 30-year fixed-rate mortgage at 7%. His monthly principal and interest payment comes out to be about $2,129. David, with his 745 score, gets offered a rate of 6.5%. That 10-point difference got him into the lender's top pricing bracket. His monthly principal and interest payment is $2,023. The difference is $106 per month. Now, $106 might not sound like a life-changing number. You might think, I can handle that. But that's a trap. That's the cost of a full family streaming package, your premium music subscription, and a nice dinner out every single month. But the real story, the truly staggering impact, isn't told in months. It's told in years. Over the full 30-year term of the loan, Mark, with the lower score, will pay a staggering $446,400 in total interest. David, just 10 points higher on the credit scale, will pay a total of $408,300 in interest. Mark will pay over $38,000 more for the exact same house, all because of a 10-point difference in his credit score when he applied. Let that sink in. $38,000. That is a brand new car. That is a kitchen remodel. That is a significant chunk of a child's college education. It is a life-altering amount of money, and the only difference was a handful of points that separated the good from the great. And the impact doesn't even stop there. If Mark and David had put down less than 20%, they would have needed private mortgage insurance or PMI. Guess what? The cost of PMI is also tiered based on your credit score. So Mark wouldn't just be paying a higher interest rate. He'd be paying a higher monthly PMI premium as well, compounding his financial disadvantage every single month. A higher score doesn't just save you money, it buys you a better experience. With a 740-plus score, you're in the driver's seat. Lenders are competing for your business. You can shop around, compare offers, and negotiate from a position of strength. The underwriting process is smoother because you are a proven low-risk borrower. They aren't digging for reasons to deny you. They're looking for ways to get the deal done quickly. For someone in the lower tiers, the experience is the opposite. You're not choosing a lender. You're just hoping one will choose you. The process can be a grueling, stressful marathon of providing extra documents, letters of explanation for every single blip on your record, and waiting weeks for a conditional approval that might fall through at the last minute. So you've seen the map, you know the destination, that 740-plus paradise where money is saved and stress is eliminated. But how do you actually get there? What are the fastest, most effective strategies to boost your score before you apply for a loan? What are the hidden traps that can drop your score by 50 points overnight, right when you can least afford it? Let's start with the traps, because they are the financial landmines that can detonate your homeownership dreams just as you're about to cross the finish line. The number one mistake, the one that lenders see every single day, is opening new lines of credit in the months leading up to your application. You see a great deal on a new credit card with a huge sign-up bonus, or a 0% financing offer on a new laptop. You think, what's the harm? The harm is a hard inquiry on your credit report, which can instantly ding your score by a few points. But more importantly, it lowers the average age of your credit accounts, a factor that makes up 15% of your FICO score. Think of your credit history like a seasoned sports team. Every account is a player. When you add a brand new rookie, the team's average experience level drops. Lenders want to see a team of veterans, a long, stable history of you managing debt responsibly. That new credit card, right before the biggest financial game of your life, is like benching your star player for a rookie nobody's ever heard of. The second hidden trap is closing old credit card accounts. This feels so counterintuitive. You think, I want to show the lender I'm responsible, so I'll close this card I never use. This is a catastrophic error. When you close an old account, especially one with a zero balance, you lose that account's entire history. If it was your oldest card, you've just dramatically shortened the average age of your credit. Even worse, you instantly lose that card's credit limit from your overall available credit. This causes your credit utilization ratio to spike, even if your spending hasn't changed. Imagine you have 2 cards, each with a $10,000 limit, for a total of $20,000 in available credit. You have a $2,000 balance on one card. Your utilization is a healthy 10%. Now, you close the card with a 0 balance. Suddenly, you still have a $2,000 balance but only $10,000 in available credit. Your utilization just doubled to 20%. You tried to look more responsible, but you ended up looking twice as risky to the lender's algorithm. And the third trap, the one that causes underwriters to physically slam their foreheads on their desks, is making a large purchase on credit after you've been pre-approved, but before the loan has closed. You're excited. You've been pre-approved for your dream home. You go out and finance a whole new living room set, a big screen TV, maybe even a new car to put in the garage. The problem is, lenders do a final credit check, a credit refresh, just days or even hours before closing. When they see a brand new $10,000 furniture loan or a $30,000 auto loan, alarm bells go off. Your debt-to-income ratio, the single most critical number in their final decision, is suddenly thrown completely out of whack. I've heard horror stories of people getting a call on the day of closing, their moving truck packed and waiting outside, only to be told their loan has been denied because they bought a new refrigerator on a store credit card the weekend before. Do not touch your credit. Do not even breathe on it too hard between pre-approval and getting those keys in your hand. So now that you know what not to do, let's talk about the powerful proactive strategies to send your score soaring. The single fastest way to see a significant jump in your score is to attack your credit utilization. This is the big one. 35% of your score is your payment history, but 30% is how much you owe. While you can't change your payment history overnight, you can absolutely change your utilization in under a month. The general rule is to keep your utilization below 30%. But if you want to supercharge your score for a mortgage, 30% is for amateurs. You need to aim for under 10%. And if you want to truly optimize your score, the secret pro-level strategy is to get it under 6%, or even as close to 1% as possible. Here's how you do it. Most people think they just need to pay their bill by the due date. Wrong. Your credit card issuer typically reports your balance to the credit bureaus on your statement closing date. This means that even if you pay your balance in full every month, if you charge $2,000 that month, your issuer might report a $2,000 balance, making it look like you're carrying debt. The trick is to find out your statement closing date for each card and pay down the balance before that date. Pay it down to almost zero. A tiny balance, maybe $5 or $10, is often better than a pure zero, as it shows the account is active. By doing this, you ensure that when the lender pulls your credit, the bureaus are reporting a minuscule utilization rate, which can boost your score by 20, 40, even 60 points in a single cycle. The second strategy is a bit like credit hacking, and it's called becoming an authorized user. If you have a trusted family member, a parent or a spouse, who has a long-standing credit card account with a high limit, a perfect payment history, and a very low balance, you can ask them to add you as an authorized user. You don't even need to have the physical card. The moment you are added, their entire positive history for that account can be grafted onto your credit report. Their 20 years of on-time payments, their $20,000 credit limit, it can suddenly appear on your file, boosting your average age of accounts and crushing your utilization ratio. A word of caution. This only works if the primary cardholder is impeccably responsible. If they miss a payment, it becomes your missed payment too. This is a strategy built on trust, but when it works, it's like a magic wand for your credit score. Strategy number 3 is for cleaning up past mistakes. Let's say you have a couple of 30-day late payments from 2 years ago that are still dragging your score down. You can't change the past, but you can ask for forgiveness. This is done through something called a goodwill letter. You write a polite, professional letter to the original creditor. You don't dispute the late payment. You own it. You explain the circumstances. Maybe you were in the hospital or lost a job or simply made a mistake. You then highlight your excellent payment history since that time, demonstrating that it was an anomaly. You end by politely requesting a goodwill adjustment to have the negative mark removed from your credit reports. It's not guaranteed to work. Many creditors will say no. But if you get a sympathetic customer service representative on a good day, they have the power to erase that mistake forever. Sending a few letters costs you nothing but time, and a single removal can be worth 30 points on your score. Finally, there's the secret weapon that only your mortgage lender can deploy: the rapid res score. A rapid res score is exactly what it sounds like. Normally, when you pay off a credit card or fix an error, it can take 30 to 60 days for that information to be updated on your credit report. When you're trying to lock in a low interest rate, you don't have 60 days. With a rapid res score, your mortgage lender can submit proof of a change, like a letter confirming a zero balance on a credit card, directly to the credit bureaus. The bureaus are then required to update your file and issue a new, higher score within about 72 hours. This is an incredible tool. If you're just a few points shy of qualifying for a much better interest rate, you could pay down a credit card, have your lender initiate a rapid res score, and potentially save yourself tens of thousands of dollars over the life of your loan. It's the final crucial step to get you over the threshold. So let's bring this all home. Your journey to mortgage readiness isn't a frantic sprint. It's a calculated campaign. 6 months before you apply, pull all 3 of your credit reports. Dispute every single error, no matter how small. Start sending those goodwill letters for any past slip-ups. 3 months out, you go on the offensive. You execute the credit utilization blitz, paying down every balance before the statement date. You explore becoming an authorized user. 1 month out, you enter a credit lockdown. No new accounts, no major purchases, no exceptions. You are preserving the pristine credit score you've worked so hard to build. Your credit score is not a grade on your self-worth. It is a strategic tool. It's the key that unlocks the door to the best interest rates, the lowest monthly payments, and ultimately, the home where you will build your future. Understanding these rules, these traps and strategies, is the difference between standing on the outside looking in and holding the keys to your very own front door. You are no longer just a borrower, hoping for the best. You are the architect of your own financial destiny, and you are ready to build something that lasts.